Dividend growth investors, bonjour. Welcome to the video you have been wanted to see for so long, the Canadian Bank's quarterly earnings. So BMO just reported on Tuesday, so we're now ready to review the big six. And at the end of this video, I'm going to offer you a narrative and investment thesis for each of them. So good reasons to buy any of the Canadian banks, because between you and me, I might have my preferences and you know them already. They are all good at something, and this is what we're going to talk about today. But first, let's take a look at year-to-date return. As of August 29, as you can see, big discrepancy between the best performing of Bank of Montreal and Royal Bank and the lowest performing Scotiabank and CIBC. Latest quarter has not been a success for Scotiabank. You can see that there's a big drop on that graph. Overall, there's a negative tendency following the market. So, even if you invest in a very solid business, in an oligopoly with strong dividend growth perspective, you're still going to be losing money this year, but it's just a matter of being patient because when you look at the results, they are not that bad. Moving on to the results. So first, let's talk dividend. No dividend increases, so this slide is going to be fast. As you can see, the payout ratio goes from 39% from National Bank to a high at 51% at Royal Bank. So even if interest rates are rising and fear recession is coming, banks' dividend are still very safe. What is quite curious about this graph though is how each bank has reported their earnings. You have companies that did well, like Scotiabank, that is plus 5%, and companies that did not so well, like Royal Bank and BMO at minus 15 and minus 10. So we're going to take a deep dive into each segment and understand what really happened here. So here I'm going to pull out all the results on your face while I'm looking at my notes and you don't see me reading. All right, so let's start with BMO. BMO, you live by the sword, you die by the sword. So they have had amazing quarters recently with capital markets. Now, expenses increase, the market was not favorable, and boom, you got 52% decrease in capital market. You can see that wealth management didn't do so well either, and this explains why BMO lagged behind its peers for this quarter. However, the growth for the personal and commercial banking for Canadian and the US side are still doing well. Higher interest rate has boosted revenue, which is definitely going to go forward. We're going to see more revenue from that interest rate. For National Bank, growth across all segments, but the international and US side. So on this point, revenue was up 10%, but higher PCLs dropped in net income by 22%. For the rest of it, banking up 11%, wealth at 10%, and then capital market, which is actually the only one that is not in red across all banking. So overall, a pretty stable and good quarter for National Bank, and we expected to see higher PCLs versus last year. TD volume helped up. The US side did incredibly well, especially Schwab at 47% increase for net income. Unfortunately, wealth, same story here, higher expenses. So we can see that it costs a little bit more to retain talent. Inflation is still affecting banks as any other businesses, and provision for credit losses increased across the board. For Royal Bank, again, same story. Hasn't been able to generate some growth actually this quarter. So the PNC in Canada was down by 4%, and then you have like slightly higher up at the results in wealth management, but plus 4% is not incredible. And what really killed their quarter and put them back to minus 15 was unfortunately higher PCLs in their US segment. So again, not incredible quarter across the banks. If we move to CIBC, you can see the same story again. Revenues revenues are up with high interest rate. Unfortunately, provision for credit loss is hurting earnings everywhere. So the thing about provision for credit losses, it's really important to understand that banks are not reevaluating their loan book at the same time in the same way. So sometimes you're going to have banks that are going crazy right away. Some others will wait a little bit more. It's really a case-by-case scenario. No methodology is better than the other. And you can see that Scotiabank actually did well because they had lower PCLs now. Obviously, quarter to quarter, it has increased significantly. But if you compare it to last year, it wasn't that bad. So the international market has been doing well. The regular personal and commercial banking as well. And unfortunately, capital market is definitely not the place you want to be this quarter, because besides National Bank, they're all went to the left field. So in the end, we have three concepts to summarize this quarter. Higher provision for credit losses, telling us that banks are expecting some defaults or maybe a recession. Higher interest rate revenue, which kind of makes sense because interest rates is rising, so at least it's a good thing for banks. They're going to make more revenue. Now it's a balance. It's a matter of balancing the provision for credit loss and the higher income. And finally, capital markets not doing that great, but you know that it's volatile. It goes up, it goes down, so it can save your quarter or it can destroy it. This is what we have seen. Now let's take a look at how banks are evaluated by the market with the 5-year PE ratio right here. As you can see, the sweet spot is around 9. We have BMO that is still super low. Probably that the market is not giving more attention to strong earnings when they're driven by capital markets, because hey, it may go down at any time. For the rest, they are pretty much trading at the same thing. One thing that is interesting here on that graph is you can see that since 2021, there is a decline in PE ratio. So there's a decline of valuation. The market is getting a bit scared about what's happening. And we have seen that so far, earnings remain strong across the board over the past 12 months, but the price of each bank is going down. So in other words, market is not confident at this moment, and this opens the door for investors that are patient and don't see for the next quarter but see for the next decade a great buying opportunity. Moving to the PE forward, so the next 12 months, you can see that there's a rebalance over here. The cheapest one, CIBC, Scotiabank, it's pretty much redundant, but they have less growth vectors. They are less performing, so obviously the market put them aside, so it's not necessarily a deal. They're being given a smaller multiplier just because they are not able to keep up with the pace with fast-growing BMO or National Bank and TD. So before I move through the investment thesis I have for each banks, let's take a look at what we have learned so far this quarter. The first thing is, TD actually decided to compensate for their lack of growth from capital market, which is kind of crazy when you look at what's happening right now, by making the acquisition of Cowen for $1.3 billion. We all know TD is more a classic savings and bank loan, and now they're thinking, you know what, we need to have a better exposure to capital market. Yes, it brings some volatility, but it also brings a lot of profit on the table. So this is a good way to open the door to capital market in the US through the acquisition of Cowen. So the second thing is winter is coming. And yes, there is a spin-off of Game of Thrones coming up in September, but there is definitely a recession coming up. It's brewing. We can see the nervosity around the market. Banks are increasing their provision for credit losses. The market is getting nervous. They are not ready to pay a higher premium for banks. So we can see that it's a little bit shaky right now. So hang tight. It may get worse before it gets better. Higher interest rate mean higher net income, but also higher provision for credit losses. So the name of the game for the next quarters, what you will want to see into each bank's earnings review, is how the revenue is increasing versus the provision for credit losses. Because it doesn't really matter if you're getting paid more interest, but people cannot afford it anymore and they just give up on the loan, right? So you have to be very careful about that. And finally, speaking of provision for credit losses, Each bank will manage them differently, so you cannot compare what Scotiabank did with what BMO did this quarter, because they're all independent. So it's not just like they're sitting around the table and then they're talking and then they agree on what's going to happen next. They each do that on their side. So provision for credit losses is at their discretion. They have their own rules. So do not jump on conclusion. And one more thing about that, keep in mind that they rather be conservative and then next year say, hey, you know what? We have a recovery. And when they have a recovery on provision for credit losses, it means that they take that off from their book and it transforms that money into earnings, which is pretty cool, right? So, Canadian banks are like Canadian rock stars, right? They are strong, they are paying dividend, they are thriving, they're safe, stable across time. But they're not only Canadian banks that are like that. There are a lot of other Canadian rock stars, and I have created a list right for you. So what I've done is I've used the dividend triangle. I use my DSR tools to pull out with filters the best Canadian stocks and the best US stocks. Put that in an Excel spreadsheet where you can play around with the metrics and identify your next purchase. And you can download that for free just using the link below before the comments. And now we're gonna look at my investment thesis. For each bank, there is something special. And I think it's good to remind ourselves why we should invest in one bank or the other. So let's go with the first one, BMO. Well, BMO is all about momentum. It's about the capital market. It's about very heavy on investing and wealth management. So if you are ready to ride a rocky boat, BMO may eventually pop up and generate a lot of returns as they did in 2021, and they can also hurt your portfolio a little bit. But overall, this is a great bank geared towards probably like the best growth vector in the financial industry right now, capital markets and wealth management. If you like underdogs, go for National Bank. I say underdogs because for me, it's clear it's the best performing banks for the past 5, 10, 15 years. However, since it's a small one, mostly based in Quebec, low volume compared to the other banks when you're looking at the trading volume, well, you may be scared a little bit, but National Bank has plenty of growth vectors. They're very well diversified, so they know that they are based in Quebec and they need to expand. So they went with more acquisition outside of Quebec. They decided to expand in Canada through private banking without having like the complete branches, but just private banking, wealth management, which is like, let's be honest, the most profitable way. So this is how they're going to be able to grow in the future. For TD, well then, it's a vote for stability, a classic business model, savings and loans, and now they're opening up to capital market a little bit more, so I kind of like that. I also like the US exposure. Obviously, 1/3 of their business is made outside of Canada, so it's a great way to diversify risk, which is not that easy when you look at Canadian banks. For Royal Bank, it's all about diversification and playing on the big guy. Similar to TD, they're like both number 1, number 2 in many categories across banks. For Royal Bank, you have 50% of their business model around net interest income, so the classic savings and loans, and the other half, 50% of their revenue is coming from capital market, wealth management, and insurance. So if you want to have like something steady, but a little bit more diversified in terms of business segment than TD is, Royal Bank should be your choice. Moving on to the last two laggard, my two least favorite, CIBC and Scotiabank. If you go with CIBC, it's pretty much like a copy of TD, but they do things a little bit less profitable, a little bit less growth. So they lack a little bit of growth, but you can be rewarded with a higher yield. Which is interesting with CIBC and Scotiabank right now is that you're going to get a very high yield compared to the other four. However, your dividend is not at risk and it will continue to increase. The main difference that you're going to see is in the total return. And again, past performance does not equal future performance. So maybe I'm going to be wrong and maybe CIBC and Scotiabank are going to skyrocket in the next 5 years. But in the meantime, the market doesn't believe that. I don't believe that, but you get rewarded with a decent yield. For Scotiabank, I think the main attraction right now is yield. You're going to tell me about the international market and it's a seductive narrative, and I agree with you. The problem is it's been more than 10 years and Scotiabank has failed to show that growth. Yes, they are there. Yes, it's not doing bad, but it's not outperforming what we have seen in Canada and in the US for other banks. So if you're telling me that this is their best weapon, well, it's not that effective. So for that reason, I'm out. Finally, if you're eyeing Laurentian Bank, that's probably because you like Couche-Tard or you like convenience stores, because this is not a bank. This is a Lehman stand on the side. It's cute, it's nice, it may be temptive, but I would completely forget about this one. I know I'm being a bit arrogant, and I'm sorry if you have shares of Laurentian Bank, but I didn't never like this bank for a while. I've called for selling this stock a while ago. The dividend cut didn't surprise me during the pandemic. It's just, they don't have the scale, they're too small, and they just cannot fight in this world of big behemoth, and they don't have anything special. So now you're just betting on an underdog that has nothing, that has never proved anything, and has no character. So be very careful with that. All right, guys, I hope that you have enjoyed this video about Canadian banks. Go in the comments and share with me your investment thesis about the Big Six, or maybe Laurentian Bank, or I didn't talk about Canadian Western Bank. So I'll be welcoming any comments on those. Let me know what you think about banks. Let me know what is your favorite for the upcoming quarters and which one you are holding forever. All right, so don't forget to subscribe to the channel, give me a thumbs up, it helps the channel tremendously. And until the next video next Thursday, don't forget to stay invested.